Have you ever wondered how millionaires build their wealth? How do they create multiple income streams, while the average person is usually left with just one? In today's video, we will unveil the 7 different types of income that the average millionaire has in their portfolio. So, buckle up, and let's explore these income streams together. And remember, if you enjoy learning about business, money, and psychology, hit that subscribe button and the bell icon to never miss an update. Now, let's dive in. 1. Earned income. Earned income is what you receive for the work you do for an employer, encompassing everyone from entry-level employees to top executives. Even professionals like doctors, nurses, and lawyers fall into this category. What unifies these individuals is that they all exchange their time and effort for money. This exchange is known as active income because your direct involvement and active work are necessary to generate this income. Although earned income is the starting point for most people, and it can provide a comfortable living, it comes with certain drawbacks. One such drawback is the inherent limitation in how much you can earn. Since everyone has the same 24 hours in a day, there's a finite amount of time you can dedicate to work. As a result, there will always be a limit on how much money can be made through this income stream. This ceiling is a disadvantage if you aspire to accumulate wealth or become financially independent. Moreover, earned income is generally subject to the highest tax rates. Depending on your tax bracket and location, taxes can take a significant portion of your earnings. Consequently, relying solely on earned income can lead to a suboptimal financial situation and hinder your wealth-building goals. Despite its limitations, earned income remains an essential foundation for many self-made millionaires. It allows you to gain valuable skills, build a network, and potentially save money to invest in other income-generating opportunities. However, it's crucial not to become complacent and rely solely on this income stream. Instead, look for ways to diversify and explore other income sources, which can offer greater financial stability and long-term growth potential. 2. Profit income. Profit income is generated when you sell a product or service at a price higher than its production or acquisition cost. In today's digital age, starting a business that generates profit income has become significantly more accessible, thanks to the internet and various online platforms. Your business model can determine whether your profit income is active or passive. For instance, if you personally create products and sell them, you are actively involved in the income generation process, making it active income. On the other hand, if you design a product and outsource its manufacturing or create digital products, you can potentially generate passive income, allowing for easier scalability. There are 2 main types of profit income: individual or small scale, and highly scalable. The individual or small scale type involves creating or flipping products manually, such as selling items on eBay or Facebook Marketplace. This approach can be an excellent way to supplement your income, although it usually requires your active involvement. In contrast, highly scalable profit income is achieved by establishing a business and leveraging a manufacturer to produce your products, freeing up your time to focus on other aspects like sales or marketing. Another example of a highly scalable business model is creating digital products. Since digital products don't require storage, shipping, or ongoing manufacturing, they offer immense scalability potential. The taxation on these 2 types of profit income may also differ. If you're an individual operating on a small scale, your profit income is likely taxed similarly to earned income. However, by forming a company, you may be able to take advantage of various tax breaks and optimize your tax situation. 3. Interest income. Interest income is the money you earn by lending your funds and collecting interest on the loan. There are several ways to create interest income. You can lend money to a bank in the form of a certificate of deposit, invest in corporate bonds, or purchase government-issued treasury bills. These investment vehicles are generally considered safe options, as they involve well-established institutions that are unlikely to default on their debts. However, the trade-off for this safety is often a lower return on your investment. The primary advantage of interest income is its passive nature. Your active involvement is minimal once your funds are invested, allowing you to earn money without dedicating substantial time or effort. There may be other, more creative ways to generate interest income with potentially higher returns, but they often come with increased risk. For example, peer-to-peer lending platforms can offer higher interest rates than traditional bank investments but expose you to the possibility of borrower defaults. 4. Dividend income. Dividend income is generated when you invest in stocks that distribute a portion of their profits to shareholders. By purchasing a company's stock, you become a shareholder and own a small piece of the company. When the company reports profits, they may choose to issue dividends to their shareholders, typically on a quarterly basis. The advantage of dividend income is that it allows you to share in the company's success, providing you with a steady stream of income based on the company's performance. As a shareholder, you receive dividend payments proportional to the number of shares you own. Over time, consistently profitable companies can provide a reliable and growing income stream for their shareholders. Taxation on dividend income can also be more favorable compared to earned income, depending on the type of dividend and your income level. To benefit from dividend income, it's essential to research and select companies with a strong track record of profitability and dividend payments. Additionally, it's wise to diversify your investments across multiple sectors and industries to minimize risk and ensure a steady flow of dividend income. 5. Rental income. Rental income is derived from leasing real estate or other assets to individuals or businesses in exchange for regular payments. Although rental income is often associated with residential properties, there are other types of real estate that can generate this type of income as well. Commercial properties, such as office buildings or retail spaces, and industrial properties, like warehouses or manufacturing facilities, also provide opportunities for rental income. The appeal of rental income lies in its potential for long-term, steady cash flow. When managed well, rental properties can offer a reliable source of passive income that increases over time as property values and rental rates appreciate. Additionally, rental income can help offset expenses associated with property ownership, such as mortgage payments, taxes, and maintenance costs. It's important to remember that rental income isn't limited to real estate. Other types of assets can be leased to generate income, such as vehicles, equipment, or even instruments. For example, some individuals rent out their cars through peer-to-peer car-sharing platforms, while others may lease specialized equipment to businesses or contractors. To maximize rental income potential, it's essential to carefully select properties or assets with strong demand and attractive rental rates. Additionally, effective property management, tenant screening, and maintenance practices can help ensure the long-term success of your rental income strategy. 6. Residual and royalty income. Residual and royalty income is generated when creators continue to receive payments for their work even after it's done. This form of income is common among artists, writers, musicians, and other creators who produce content that retains its value over time. Residual income typically comes from ongoing sales or usage of a creator's work, while royalty income is earned when others use their intellectual property to generate revenue. For example, an author who writes a book will continue to earn income as long as the book keeps selling, and a musician will receive royalties every time their song is played, streamed, or sold. In the entertainment industry, actors can earn residual income from films or TV shows that continue to generate revenue through syndication or streaming platforms. Royalty income can also come from various sources, such as licensing agreements for products, merchandise, or adaptations. The appeal of residual and royalty income lies in its potential to provide long-lasting, passive income that rewards creators for their work long after its completion. To maximize this income stream, creators need to produce high-quality, timeless content that resonates with audiences and retains its value over time. 7. Capital gains. Capital gains income is generated when an asset, such as real estate or stocks, is sold for a higher price than its original purchase cost. This type of income rewards investors for their ability to identify and invest in assets that appreciate in value over time. Common assets that produce capital gains include stocks, real estate, collectibles, and even cryptocurrencies. Capital gains can be subject to lower tax rates if held for longer periods of time. To maximize capital gains potential, investors should focus on identifying assets with strong growth prospects and carefully monitor market conditions to determine the optimal time to sell. Understanding and implementing these different income streams can greatly improve your financial situation and open doors to new opportunities. So, which income stream caught your attention, and which one will you pursue next? Let us know in the comments below. With that said, thanks for watching, and until next time.